Man, this past week in the markets was a total roller coaster, right? We saw a stomach-churning plunge, and then, out of nowhere, this massive rally that's left every single investor asking the same thing. Was that the bottom, or was it just a dead cat bounce before the next big drop? Well, in this explainer, we're going to break down both sides of the argument.
We're going to frame this whole thing as a tug-of-war. First, we'll dive into the absolute chaos of last week and what sparked it all. Then, we'll get into the main event, the bull case versus the bear case. And finally, we'll look ahead to what is shaping up to be a make-or-break week for the markets.
Okay, so let's set the scene. The week started with a really brutal market-wide plunge, but it ended with one of the sharpest one-day rallies we've seen in a long time, a surge that honestly looked a whole lot like pure panic buying.
You can really see the whiplash right here on this chart. The Nasdaq was deep in the red for the week, but then, boom! A single day of frantic buying just about erased all of those losses. It was a pretty stunning reversal.
So here's the crucial part. After all that chaos, where did the market land? Right back on a critical technical support line, the 100-day moving average. Now, holding this level is a really big deal, but it begs the question, what on earth could cause such a sudden and powerful U-turn?
Well, the catalyst wasn't some big economic report. It was actually something much simpler. Words. Just a few surprisingly dovish or, pro-growth comments from some key Federal Reserve officials that completely flipped the market's mood on its head.
First up, we heard from the very influential NY Fed President John Williams. He basically signaled a major shift in the Fed's focus. They're moving away from fighting inflation and are now more concerned about protecting the job market. What the market heard was, hey, the danger of more rate hikes is fading.
And then, as if that wasn't enough, Fed Governor Mayhem took it a step further. He didn't just hint at it, he came right out and said he's ready to vote for an interest rate cut, like right now. This was so unexpectedly direct and dovish, it was like pouring gasoline on the fire.
This quote here really shows you the change in tone. See, a big worry for the Fed has been this fear of an AI-fueled stock market bubble. But here you have the vice chair actively downplaying those fears. What he's really doing is removing a major roadblock that was standing in the way of potential rate cuts.
So this sudden pivot from the Fed, that's the entire foundation for the bull case. The argument is that we just witnessed what's called capitulation, that final panic moment when the last of the sellers just give up and throw in the towel, which often marks the exact bottom of a correction.
Think of it as the point of maximum pessimism. It feels like the world is ending, but ironically, that's often when the market has literally nowhere to go but up.
And you know what? There's actually some solid evidence to back this up. Traders at Goldman Sachs said they saw signs of capitulation, especially in tech, which was the most beat-up sector. At the exact same time, we saw this massive spike in fund managers buying protection and investors piling into short positions, all classic signs of peak fear.
But of course, the bears are looking at the exact same data and seeing something completely different. They're arguing this wasn't the bottom at all. No, they think this was a classic dead cat bounce. Just a brief, deceptive rally before the market continues its slide down.
Yeah, these were the kinds of rallies that are so dangerous. They suck in all the hopeful buyers, making them think the worst is over, right before the market rolls over and falls to even lower lows. It's a classic trap.
And the bears, they're pointing to some really troubling signs just under the surface. Get this, the market's most important stocks, the mega-cap tech giants, they actually fell for a third straight week. A huge player like Oracle just broke below a critical long-term level. Meanwhile, you see money flowing out of tech and into defensive hideouts like healthcare. That's a classic sign that investors are still running scared.
So you've got two perfectly opposite arguments. Who's right? Well, to get a clearer picture, let's step back for a second and see what other markets are telling us about this intense tug-of-war.
Okay, first look at the US dollar. It just keeps getting stronger. Now, a strong dollar is typically a major headwind for stocks because it tightens financial conditions around the world. So this is a clear point in the bears' favor.
Now, over in the crypto world, the signals are, well, they're all over the place. Bitcoin just had its worst drop since 2022, but at the same time, crypto ETFs saw huge net inflows. But here's the catch. The single biggest player in the space, BlackRock, was actually a net seller. It's a messy, conflicted picture that honestly captures perfectly how investors are feeling right now.
All of these conflicting signals bring us to the one question that really matters now. Where do we go from here?
I mean, after weighing all the evidence, you've got the Fed's pivot, you've got signs of capitulation, but also that underlying weakness and the mixed signals from other markets. Which side is actually winning this intense battle for the market's direction?
The truth is, the market is perfectly balanced on a knife's edge, and this coming week is just packed with events that could tip the scales, including a really key Supreme Court decision on tariffs that could throw a whole new layer of uncertainty into the mix.
So the big takeaway here is that this battle between hope and fear is completely, totally unresolved. The market is coiled up like the spring, and it could break sharply in either direction. The only question now is, which side is going to flinch first? If you found this video helpful, be sure to smash that like button and subscribe so you don't miss your next Daily Edge. More news in our Telegram channel in the first comment. See you next time.